Welcome everyone to the Daniel Krug & Associates Wealth Management Review for May 19, 2022. Today's presentation is titled Markets, Headwinds, and Investing in Retirement. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug & Associates. Daniel Krug will be joining me in this presentation. Just a reminder, this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. If you have any questions, please call the office and we will handle it with you directly. Today we're looking at about a 30-minute presentation. We are recording this for reviewing and viewing later. Everyone will be muted on this call. If you have any questions, you can type them in the chat room and we will follow up with you after today's presentation. We also want to thank AssetMark and City National Rockdale for their research. The agenda for today that we're going to cover is what's going on in the current markets, what are some of the market headwinds, and investing in retirement.
All right, Rocky, we got a lot to go through. I mean, this market has just been up and down, and I'm sure a lot of the clients are wondering, when is this going to end?
Kind of feels like they went to Cedar Point, but not enjoying it as much.
That's right. Well, I don't know about you, but the last time I was on a roller coaster, I did not enjoy it at all. Well, you know what? You get older, maybe you don't like that stuff as much. Right. So why don't we go ahead and dive right into the markets so we can see what's going on and we can explain what we see so the clients can feel a little bit more comfortable about what we're going to be doing down the road here from an economy and market standpoint.
Sounds good. So Dan, why don't you take over?
Okay, so for the markets, what I would like to talk about and what I'd like to show you is where we are today, where we started at the beginning of the year and where we are today on three different indexes. So you've got the S&P 500, the aggregate bond fund, and the NASDAQ. And as you can see in this chart, the S&P 500, which represents 500 stocks, it's kind of in the middle of the road between the NASDAQ, which is more tech-heavy stocks, and the aggregate bond fund, which is more bonds in the portfolio. You can obviously immediately tell that all three are down right now, but the S&P is kind of in the middle there. And the reason we bring this up is we want to give you a little idea as to what is causing some of this volatility and how is the makeup of the market with some of the tech-heavy stocks, how is that actually affecting where the S&P 500 is right now? I'm sure you know that from past videos that we've done that there were 5 or 6 tech-heavy stocks that really represented a very large percentage of the S&P 500. And we're going to highlight some of them right now because they were very high flyers last year, but they're struggling a little bit right now. If you look at this, you've got big names and big declines. So on this chart, we have the S&P 500, again, down 15.91, Netflix, Facebook, Amazon, and Disney. And as you can see, these are big stocks, but they're also having a heavy impact on the S&P 500 because they are down so much. I mean, just look at Netflix. They're down 69% as of 2 days ago in the market. Facebook, you know, when earnings season hit, Facebook lost millions of subscribers, and the earnings report didn't sound too good. And that was reflected in what happened with the stock. And you see that it kind of took a nosedive in the beginning of February and is currently down about 41%. Amazon, you know, they took a little bit of a dive. Disney, I think they're falling out of favor. There's a lot of very conservative people that are concerned about the direction Disney's going with our children. And that's kind of weighing on the stock. And then you have what's going on in Florida where the governor is kind of taking some privileges away, and that's weighing on that stock as well. If I move forward, looking at three additional, now these different stocks, I mean, they have really nothing in common. You've got Moderna, which is a pharmaceutical, Nvidia, which is semiconductors, and then Ford, which is obviously automobiles. You look at how they're doing compared to the S&P 500. The S&P 500, again, just about down 16%. Ford down 37, Nvidia 41, and Moderna is just getting spanked right now at 46% down. But they are weighing on the S&P 500 as a whole. You can see, based on the total downturn with all these different large stocks, that it is putting a drag on the overall portfolio when it comes to the S&P 500. And ultimately, the average stock in the S&P 500 isn't even down 15.91%, which is kind of represented in a lot of well-diversified portfolios. Now, moving forward, this chart here shows the S&P 500's 20 best performers in 2021. And you'll notice that there are three big stocks on here that we had on the list. Moderna was one. They were up 143%. Now they're down significantly. Ford was up 137 in 2021, down significantly. And Nvidia, same thing, up 125%, but coming down significantly for 2022. And the interesting thing to note, and if you've, again, been in any of our workshops relative to the market, you'll know that 80% of the high flyers from the bull market, see, I say that, high flyers, and the bells just go off. The high flyers from the previous year, 80% of them tend to be dogs the following year. And that's kind of playing out in many scenarios right now. One divergence from that statistic is obviously energy stocks. They were up last year, and they're already up for this year. And most of you have some kind of energy stocks within your portfolios. Now, let's go back to the S&P 500. The S&P 500 hit a high at the end of last year at 47.96. Now, what's happened since? Well, that's that roller coaster we were talking about. The first support that we were looking at was at about a 16.6% drop in the market. And the market came down and it kind of settled on that for a little bit. And then what happened? It dropped even further. So then we were looking at the second support. And that second support actually came down and hit it at 19.26. And over the last couple days, it's been bouncing off and is back above support number one. Well, hopefully, and I'm sure everybody would agree with this, we'd like to see that be the bottom and we're going to be moving forward, but you can't really 100% guess the market. I mean, I'm sure most of us have figured that out. So there is a third support that we're a little bit concerned about, and support 3 actually brings us into correction territory at over 22.86%. And we're looking at this from a charting standpoint. Now, you cannot put all your eggs in a charting basket. It's just going to help give you an indication of where the market is going. You really need to look at more of the fundamentals, but this is something we do look at to get a feel of where the market's going and whether it's going to go down much further. So we're in a position, if it does bounce off and stays off that 19.26 support, I think we're going to be in pretty good shape moving forward. And I don't think it's going to be smooth riding, Rock. It'll probably be more of the volatility, but I'm still believing that we're looking at, by the end of the year, based on all the economic and financial data that we have, the forward-looking data is telling us we should be able to come out positive by the end of the year, which really does breed opportunities at this point. If you're in a position where the market is down 19%, and you're looking at it like most of our clients do and say, okay, where's the opportunity here? Well, goodness gracious, wouldn't a Roth conversion be perfect at this time? The market's down, you're actually converting a higher percentage of your IRAs to Roth because the overall account is down. You get it converted, you pay the taxes, and then you write it up. Even if all you did was write up to even, that's about a 20% return tax-free. It's an awesome time to do a Roth conversion. Other people are looking, Rock, and saying, you know what, maybe I need to get more money into the market. I just had a client the other day say, you know what, I got some extra money. Do you think it's a good time? Yes, it is. It's a good time. Don't even worry about whether the market drops another 5%. You can't time the bottom. But even if it does drop another 5%, it's going to capitulate, and ultimately, we believe at the end of the year, it will be up. So it's a very good opportunity to enhance your returns based on where the market is today. Rocky, I think that brings us up to you. You have any thoughts on that?
It's just been interesting, and I think that there's reasons that the market's been so volatile.
There is.
And I think that's what we're going to go into now, talk a little bit about what we see as the headwinds and the things that are going on that are causing this volatility in the market. So
let's move forward then.
Let's do it. So, like I said, I'm going to talk about the current headwinds. And basically what we're looking at are the two main headwinds that are going on is inflation and the Russia-Ukraine conflict. So when we talk about inflation, what we're actually looking at is a historically high amount of inflation that came in very, very quickly here at the end of last year. And when you look at this chart, what you're looking at is the consumer price index in two different, the average U.S. city and the one with less food and energy. So what this is showing us is actually we had inflation pretty much tamed from the end of the 80s going into the 90s, came down a little bit. Of course, when we were in the Great Recession of 2008 and 2009, you could see that the inflation started to pick up, which was good because we actually were in kind of a stagnant economy. And it stayed kind of flat from the Great Recession of 2008, 2009, all the way into last year. But towards the end of last year, we really started to see the inflation take off, primarily due to the amount of printing of money that we've done in the U.S. for stimulus. Many said that we really didn't need any more stimulus, and I think we're paying the price of that additional spending, that $2 trillion of extra printing that took place. The economy was actually doing pretty good, Dan. It just didn't make sense why we needed to pump more money into the supply at that time, but that's what happened.
You know, I think you're right, Rocky, and I don't know how many people I talk to, really clients as well, that are saying, you know, why are we giving all this money away? They keep talking about how strong the economy is, but yet they're still printing money. Is that going to create a problem down the road? And they have been kicking the can, and they just kicked it a little bit further, but we'll see how it plays out.
Right. So the Fed is trying to make adjustments. We'll talk a little bit about that down the road here a little later on. But just remember, inflation has been persistently high this year, and that's a big drag on the economy for the future. The other headwind we're talking about is Russia and Ukraine and what's going on over there with the Russia moving in and invading Ukraine. What I want to focus on today is what is that impact, though, to the United States economy? And there's two major things that Russia or Ukraine export, and the first is oil. They're the world's third largest oil producer, and when you look at the pie on the left, you can see how much Asia and Europe is impacted by Russia's exporting oil to them, making it very difficult to bring in sanctions or respond to the situation over in Russia and Ukraine. However, when you look at the U.S., in here, it's a very, very small percentage of our oil consumption. Most of our oil comes from Canada and Mexico and ourselves. So we have not been energy dependent on Russia. When you look at the right side of this chart, the Russia-Ukraine produced 25% of the global grain exports. Again, Europe, a big consumer, Egypt, Turkey, a little bit China too. But the U.S. is not a major consumer of Russia and Ukraine grain. So what does that tell us? That really from an economic standpoint, we would be impacted minimally, Dan, compared to the rest of the world. So what that brings us back to is really inflation is what's going on in the U.S. that's causing most of our problems right here today. So
yeah, it is interesting because I think Ben Carson said this, that we really do want to get some kind of alternative energy other than just the fossil fuels. I think that long term, that's important. We've got to come up with another energy source. But one of the things he said was that you don't stop what's allowing you to grow to then focus on the new energy sources before you get the new energy sources in play. So it might be wise if the current White House would kind of let us do the thing with oil and at the same time, work on that alternative energy, because
Yep.
I think it's a good thing to do.
you can do both.
Absolutely.
We're not restricted.
Absolutely.
So now that we know what's going on, the geopolitical conflict, the inflation situation, what does history tell us? So when you're looking at the inflation and the markets, monetary tightening plus growth still can mean there could be good equity returns. This chart shows us that through all cycles, the left two bars, in the first year of the Fed tightening, increasing interest rates, the stock market historically has averaged 7.8% return, the S&P 500. In the second year, 5%. The middle bars show that if the economy is actually expanding and we're in a good economic situation and the Fed starts raising interest rates, we could see double-digit returns in the first and second year. The third set of bars, though, reflect what happens if the country is actually, the economy is in a recession, we're not growing the economy, what's the return of the S&P? And you can see it's significantly lower, 5.8% in the first year and 3.4% in the second year. So what this is telling us is, and why the stock market is so volatile and why we've seen a drop in the stock market, a correction starting to take place, is because people are not sure right where we're at right now. We've been expanding, we are still expanding, which puts us in the middle chart. But there's concerns that we could be heading to a recession, and that means that there could be lower returns in the future, thus the market volatility as we're trying to weather through this current inflation cycle that we're in and the Fed raising interest rates. When you look at conflicts, we've had them. This chart takes you back to 1975, and you can see a whole list of different geopolitical events that had taken place over the past 30, 40 years that we somehow have been able to power through those different events, and the stock market can still move forward even though there's conflict going around the world. So the point is, inflation's got to be held accountable. We've got to do things to bring it in line, but be kind of careful in how it's being done. And, the war, hopefully it doesn't escalate. And you can see that the S&P and our economy can power through these kind of events.
On this chart, here's the interesting thing, because, let's take the COVID shutdown and the downturn of the market there, because that was almost like a blip, right? It was emotional, but it was kind of like a blip when you look at the long scheme of things in the market. But when you go back to 1995 all the way to 2015, we were in a secular bear market for equity. So what do most people think about when they think about recession? They think about the two big ones we just had in the 2000s. And what I'd like to point out here is we are not in a secular bear market for equities right now. We're in a secular bull market for equities. So whereby a secular bear market's going to go sideways, kind of like a big W type thing. A secular bull market will go up, come back a little bit, go up even higher, come back a little bit, and go up even higher. So I think that's why some of the reports that we're seeing are saying that even if we go into a recession, it may not be what people were accustomed to in the 2000s.
Yep, good point. So next we're going to talk about where we're headed, Dan, but like you just said, there's a lot of things that are still good in the economy.
Oh my goodness, yeah.
The interest rates are low, unemployment's low, so it's really just trying to work through the supply disruptions, the inflationary aspects of what's going on, so on and so forth. So let's go ahead and talk about where we may be headed. We're going to start by looking at the economic charts and indicators that we've showed you every time we get together or as we do these webinars and workshops. This was the January 22, the beginning of the year, leading economic indicators. And if you remember, this is kind of like a stoplight. Green means the trend is moving positive. Yellow means the trend is kind of neutral, not necessarily moving positive nor negative. And red means definitely that trend in that indicator is moving negative. In January, pretty good picture. I mean, it wasn't perfect, the political environment, the equity market valuations were pretty high, but geopolitical risk, we didn't have the war yet. So it still looked like we were going to see a expanding economy, however, a little slower than 2021. Fast forward to where we're at today, and you can see the picture has changed quite a bit. The indicators are moderating, but many remain positive. So on the balance, it's still reflecting generally solid fundamentals. You know, we've seen a little bit of a shift, obviously, geopolitical, with the war breaking out between Russia and Ukraine. That's moved red, so that's a negative trend. Other trends, monetary policy on the top of the line there, the top group, and yield curve, those kind of have moved a little bit less positive. They're kind of neutral right now. Interest rates, with them going up, that's always a more negative than a positive, but it's still historically low interest rates. So just kind of working our way through this, the bottom line, you see the inflation is a problem. Obviously, we're dealing with that. We're not at a place where it's out of control, but if we don't make adjustments and make them sustainable, we could see runaway inflation. It's been high the last couple months, and that's a concern. Energy costs, obviously, we all have experienced at the gas pump. What's going on? You know, the cost of gas and stuff like that. So there's more concern. We believe there's still secular strength in the U.S. markets, and it should offset some of the cyclical inflation headwinds. But we also have to keep an eye on what's going on over with Russia and Ukraine, because it has not slowed down. In fact, there's concerns of further escalation and further aggression by Russia. However, other countries are doing what they can to combat that through sanctions, so on and so forth. So that's kind of the wait and see at this point. When we look at economic cycles, you tend to see this kind of a sloping line where during the growth phase, it's green, everything's going up, you know, things are improving, the economy's growing, companies' revenues and profits are increasing, they're hiring, people are spending money, everything looks good. Where are we right now in that growth cycle? You can see where the US dot is. We're kind of on that slope. We're in a mature part of expansion. We had great growth through 2020, going into 2021. Now we're kind of expecting things to slow down a little bit. And when things slow down a little bit, you tend to have liquidity kind of being reduced, which makes it harder for companies to borrow and expand and bring new products online. Growth tends to slow. And this is where the Fed has to be really, really careful, and the government has to be really, really careful with their policies and how they handle inflation through raising the Fed rates and causing interest rates to go up in an attempt to slow the economy. What you see is three kind of scenarios here that we're looking at going into 2023 and 2024. Worst case is that we actually do go into a mild recession, and that's where the economy actually is slowing down to a point that it is a negative number in economic growth. We're hoping to be somewhere a little bit above that in that slow growth to normal growth, but again, this is really going to depend on how the Fed's ability to adjust interest rates to the point that it keeps the economy rolling, Dan, and not shutting us down. So if they move too quick, they can literally shut the economy down. If they move too slow, they won't control inflation. Yeah. So a lot going on.
It's really interesting because when you look at what the Fed has done historically, and we've had multiple Fed chairmen over different cycles that we've experienced in the U.S., and it seems like almost to a T, they raise the rates too fast, and they actually throw you into recession.
Right.
So that's, Powell's actually done a very good job up to this point. I mean, it remains to be seen how he's going to move forward with what's going on with the markets and the economy and everything. But I just pray they don't raise it so fast that they actually push us down that road.
Right.
Because I'm not sure it's all that necessary to push it up too fast. Although you said it, the interest rates really aren't that bad right now historically. If 5 years ago, if you will look back and seen the rates today, you would have been pounding on the mortgage company's door to refinance at that rate. So we're still very low historically.
Right.
If things don't kind of push out of control there.
Yeah, like we said, inflation is high, but interest rates are still low. Consumers are still spending. Unemployment is low. There's jobs out there. There's room for the economy to expand.
Yes.
We just don't want it expanding so fast.
Yeah,
and there's runaway inflation.
There's another interesting factor, and I actually talked to a client earlier this week on this, and that is if you look at that chart from the economic and financial indicators from CNR, they are showing what looks like actually a pretty decent chart as far as the economic indicators. What I pointed out was how did things feel in December of 2019? And they're like, well, it was actually pretty good. Things were rolling along. We weren't really worried about anything. And ironically, the charts almost look the same. So where we are right now is not as bad as a lot of people think it is, and maybe a lot of that is just because of what the news is saying. Right. The news is doom and gloom, and we've said this, turn the news off. Be very selective as to where you get your information, because it can take you down a rabbit trail that could, oh my goodness, get depress you. But, so where are we at now?
Let's move on.
All right, investment in retirement. So now we talked about the economy, we talked about the markets. Volatility is normal. You've seen this chart before. Basically, this chart is showing the S&P 500 intra-year declines versus the calendar year return. So if you're looking at the chart, the red numbers on the low side of zero are basically telling you how far did that market go down in any given year. And then the gray bars on the top of the zero line, and there are some on the below, are where the economy actually ended up. And you can see that the majority of the time, even though the market's down intra-year, it jumps up by the end of the year. So this is the reason you've got to stay engaged in the market. I hear people say, is it time to get out? Well, only if you want to lose money. Because the minute you take it out of the market, now you got a time getting back in the market. And odds are you're going to lose on that. So stay focused, stay engaged. allow us and our money managers to make the adjustments necessary and take advantage of these opportunity and the downturns that you're seeing. Because like I said earlier, great time right now for Roth conversions or adding money into the market. This is another way to look at the historical data. This chart shows specific downturns in the market, specific downturn periods, how many months it was down, what the loss was, and then how many months of recovery there were within that cycle. And again, you can see that most of them, the returns are relatively quick. So this is why we say you cannot time the market. It's not timing the markets, it's time in the market. And the people who stay the course are the people who get the returns they're looking for. Now, when you look at it historically as an average, all 16 downturns here, your average loss was 27.5. Well, that's more than a healthy correction, but the average recovery period is almost 23 months. You remove the largest and the shortest, and the average loss goes down to 24.5 and a 15-month recovery. The key here is, do we have the money set aside to weigh through the downside of the market? Do we have alternative places, alternative sources to go to when the market is down? Because what we keep telling our clients is that when you have a downturn in the market and you're pulling money out for retirement, all you're doing is accelerating that loss. So if you have another bucket of money that doesn't go down during a market correction, you're going to be in much better shape moving forward. That's why we talk, and Rocky's really big on this, and he's done a great job of illustrating out the bucket system here. And that is, when you're investing in retirement, if you're not taking any money, you probably don't need a whole lot of money off to the side in more cash or conservative. But if you are drawing significant amounts out, you should have more in those buckets. Because those buckets, they represent checking, savings, money markets, CDs, tactical fixed income, and yes, cash value life insurance, which really acts as a bond alternative, but tax-free. So it makes a great piece of good tool in our toolbox when it comes to the conservative box there. But this will allow you to ride through any kind of recessions that might come about. The second bucket, growth and income. This one's going to be more aggressive. And you're going to allow this one to grow to be able to refill your conservative bucket when the market capitulates, comes back up, and you're back on track again. And then the third bucket is your growth bucket. Now, this is a great place for Roth money, any kind of tax-free money, because you want that to grow the fastest. So the 7-year plus bucket is where the majority of your money is going to be. And, I can't say it enough, Rocky. It's not just investing, it's really growing the money properly. The asset location investing that puts our clients ahead of the game. Your IRA money, your taxable, that's your bigger problem from a tax standpoint. That's going to be more conservative. Your non-qualified money, where you get capital gains, it's more, more tax favored. Well, that's going to be more of your moderate money, and then your Roth is going to be your aggressive stuff. We want that to grow long-term, fast and hard, to give you the highest net rate of return you can possibly get. So this bucket system is just really a great tool, and the illustration really helps, I think, people all the time. You've talked to, I don't know how many clients about this, yep, that say, you know what, now I understand. Now it makes sense. I don't have to worry about the long-term market. So investing in retirement is important.
Right.
So there's a whole lot going on. Do you want to take the close on this, or you want me to?
I was just going to add one thing to that.
Sure.
Really nice about having that bucket system when we're going through a market correction like this, sitting down with the client and showing them, hey, you've got money here. in this bucket. You've got money here. You don't need to worry about this bucket that's taking the hit in the short term right now. That was always designed to be volatile. We knew that.
Yeah.
But you can weather through these storms by having these other buckets and not worrying about where your income is going to come from next month.
Absolutely.
So
Absolutely.
we're going through that with our clients and showing them and reassuring them that the strategy that was put in place is actually working.
Absolutely.
And they're not worried about the market.
Right. This is a great time. I just think there's such great opportunity out there in the market right now.
And by doing that, it allows us to take that growth bucket and go out and buy those things that are on sale.
Yeah. Yep.
So
and there's a lot on sale right now.
We like the opportunity to pick up good companies, good quality companies at a lower price than they were 4 to 6 months ago.
Absolutely.
And so that's what we're doing. So let's kind of recap where we're at, what's going on, and then we'll close out, Dan. So here's our recap. Final thoughts. The stock market is in a correction. It's been moving in that direction this year, with the technology sector suffering the biggest decline year to date. You saw that in Dan's charts. The bond market has also suffered as rising yields push existing bond values lower. Used to be 10, 15 years ago when interest rates were higher on bonds, the dividend payout, the interest payouts, you could sell some stocks and go into the bond portfolio. Can't do that today when you got such low interest rates. Plus the fact that interest rates are moving in the other direction, they're going up, it's causing a problem for existing bonds. Expect continued market volatility. Okay, you saw the chart Dan presented that the market in most years is down at some point, but most of the time, 3 out of 4 years, it recovers and ends up ahead. So for those that are long-term investors, this actually creates great opportunity.
You know, on a side note there, Rocky, if everybody remembers 2018, the last quarter of 2018, we had that correction.
Yep.
And the news media was just doom and gloom, and recession is right there at our door. And then the last week in December, it capitulated and we were off to the races again.
Right. On inflation, remember that it is running higher than what was forecasted. It's being very persistent, and the Fed has moved finally to start taking action. Again, how they do it moving forward is going to be critical to how the economy slows, and does it slow too much, or does inflation remain too high? So this is something we're watching. The Fed's going to continue to raise the rates. There's no question about it. They don't have any choice at this point. They've got to do what they can to curb the amount of inflation that's going on. Also, there's a wide range of geopolitical outcomes right now that can still happen, right? The near-term risks are high for continued Russian aggression towards Ukraine and how the world responds to that situation. So again, this is a wait and see as this moves forward. However, many sectors of the economy do remain strong, which can help offset some of this cyclical inflation. Companies are still giving good revenue reports, good earnings reports, profitability. They're hiring. They're looking for more people. They want to expand. Inflation is a problem, but interest rates are low enough still historically that companies that want to expand can still borrow, take advantage of it, so on and so forth. And when we're talking about investing in retirement, you got to remember volatility is normal. It's part of investing. Understanding that market downturns and preparing for them can help you build a more reliable stream of income. That bucket system really works. It works on the income side, so you're not worried about where the money's coming from next month, and it also works on the growth side when you're trying to reposition the portfolio to take advantage of market opportunities. And then utilizing the bucket strategy for investing in retirement, like I said, can optimize that portfolio overall to keep you on track towards achieving your goals. And with that, I'm going to pass it over to Dan.
All righty. Yeah, if you have any questions, just put it in the chat and we will watch the chat and we will get back to you. Most of the questions tend to be very specific. to individuals. So we'll give you a call if you have a question in the chat box for us. Now, solutions. We talked a little bit about them in the show today. And from a wealth management standpoint, we are a full wealth management firm. So we're looking at investment solutions, banking solutions, trust services, wealth enhancement, wealth transfers, wealth protection strategies, and charitable giving strategies. We are looking at the big picture here to enhance everything that the market's giving us and moving forward with it. So we've got plans for this. We have strategies. So you might say, tell me more. You've heard about us on YouTube. Go to YouTube. You can go to Daniel Kruger and Associates YouTube, and all of our videos are on there. If you want, it's actually easier just to go to our website at mydkna.com. Click on Watch Us. You can go directly to YouTube, and it'll take you to the site and all of our videos. We will be doing a replay of this, so look for the email that has the replay in it if you'd like to take a look at it. We'll try to break this down to bite-sized pieces as well and put it on the website for you so you can kind of take little snackables and digest them. So, you know, that kind of brings us to the end, Rocky. So there is no need to worry. You take care of your family, and
we will take care of you. We're ready for the future. Thanks again for attending, everybody.
Yeah,
we'll
thank you.
Talk to you soon.